Are you interested in a company that's been growing dividends for 38 consecutive years? Not only that, they increased their dividend by 15.5% earlier this year in January, and the price has increased by over 77% over the past 5 years. Welcome to my channel, Fiscal Voyage. I'm Felix, and I've been doing a Dividend Aristocrat series, posting a video every day with a new Dividend Aristocrat and doing a stock analysis. So if this is your first time visiting the channel, make sure to subscribe so that you get notified for tomorrow's video of the next Dividend Aristocrat. And stay tuned towards the end of the video because I'm going to provide you with a fair price versus current price, and we're going to be determining if it's a buy, hold, or sell at today's prices. Air Products and Chemicals Inc., ticker symbol APD. The company is an American international corporation whose principal business is selling gases and chemicals for industrial uses. Some of their customers are in the technology, energy, healthcare, food, and industry markets worldwide, and some of the gases are mainly oxygen, nitrogen, argon, hydrogen, and carbon dioxide. If we look at the fundamentals, from 2010 to 2019, the company was basically flat at a negative 0.1% growth. Net income, however, did grow at a nice rate of 6.2% in that 10-year period. Currently, the company has a credit rating of A, which is outstanding, and investment grade. Operating income in the 10-year period grew at a little less rate of 4.3%. And earnings growth in this 10-year period was 5.62%. And in the past 5 years, revenue actually been down worse, negative 2.56%. So revenue has been decreasing over the past 5 years. Net income, however, is much better at 8.33%. So this right here tells me that even though the company is not increasing revenue, they're reducing costs. They're being more efficient with the money that's coming in. So that's positive there. That's the reason why they've been able to grow dividends at a high rate, and we'll see that in the next slide. Earnings also only grew in the 5-year period, 5.73%. So that's better than the 5.62 for the past 10 years. And the increase in dividend growth and earnings is because the net margin for the past 10 years, in the beginning, 2010, 2011, 2012, they had net margin around 9%, 12%. Now, last year, they had net margin of 19%, and in 2018, 16%. So their revenue has been decreasing, but with the money that's coming in, they're being more efficient in generating earnings. If we continue with the fundamentals, 2019, they had earnings of $8.21. Like I mentioned, net margin at 19.7%, so that's been increasing from the previous years. Return on equity at 16.1%, which is modest, and it's been right there with the previous years. Currently, the company has a pretty low dividend yield of 2.23%, and actually, this is less than the 5-year average, which is 2.35%. So that's a little indicator there that it may be overvalued based on the dividend yield. Current yield versus the 5-year average. However, the 5-year dividend growth rate has been pretty good at 8.7%, and the company has a dividend payout ratio of only 64% based on 2020 expected earnings. And they've been growing dividends for 38 consecutive years, which is outstanding. And the most recent dividend increase was earlier this year in January, 15.5%. Of course, this is before the pandemic, but they'll still be able to pay that dividends because of the low payout ratio of only 64%. And earnings are expected to grow even higher 2021. Again, the 5-year dividend yield is only 2.35%, the 5-year average. So the current yield is much less than that, as you can see at 2.23%. And the charter rule, we get a charter score of 10.9, so it's right there at our criteria of 11, 10, 11 or higher. So if we look at the balance sheet for the company, debt to cap is only 23%, which is very low for this size company. Current ratio of 2.54, which is outstanding. You'd like to see it at 1.5 or higher, and we're getting 2.54 here. debt to equity at a nice rate here at 0.29. So their balance sheet is looking outstanding. Or in the debt to equity ratio, you like to see it, the lower the better. 1 and lower, 1.2 and lower, but this is real good here. And the price to book, however, shows a different story in the sense that of the valuation. You can see here currently the price to book ratio is at 4.67 versus the 5-year average of 3.9. This is a good indicator here that it's overvalued based on their price to book average. If any of you guys ever read the Intelligent Investor, the book from Benjamin Graham, he likes to purchase company with a price to book of 1.5 or less. So as you can see here, we get a price to book ratio of 4.67. So we look at future outlook. Analysts expect 2020 to have earnings of $8.45, which is higher than 2019's of $8.21. So not only is this company growing earnings, but it's growing earnings in a pandemic, in an economic shutdown. That just shows how resilient and how excellent this company is. So the fundamental of this company is great. 2021, they're expected to grow even higher at $9.82. CFRA has a projected earnings growth of 12% for the next 3 years, so that's great there as well. And during my dividend yield return model at current prices, you have a projected return of 10.8%. However, currently the company has a PE of 28.7, which is based on 2019 earning of $8.21, and forward PE of 28.6, so it's slightly less, which is how I like to see it. Current PE is higher than the forward PE, so that's good there. However, it's not too big of a difference. And the 5-year PE average, however, as you see, is 25.6. So that's a good indicator that the company is overvalued. So let's continue with this and see how overvalued it is. If we look at the fast graph, as you can see here, the black line is the monthly closing price. The blue is the normal PE of 20, which is what the company tends to average over the past 10 years. And the orange line is a normal multiple of 15. As you can see, 2019, the company had earnings of $8.21, and this year they're expected to be higher, about 3% higher of $8.45, and then in 2021, 16% higher at $9.82. However, you can see the black line, the monthly closing price, is much higher than both the blue and orange. So that's a good indicator that it's overvalued based on the fast graph. If the company were to go back to its mean around 20 PE of 2021 expected earnings of $9.82, you could have actually lose money. Total return of negative 14.3% and annually a negative 10.9%. So this right here is a good indicator that it may be overvalued. But if you look at the orange line, you can see the earnings growth. They had a dip in 2017 of negative 16%, but they picked it right back up at 18% growth in 2018. So the company is growing dividends and earnings. As you can see, the dividend payout ratio is the white line, so it's well covered with earnings. But let's look at the fair value price here. CFRA has a fair price of $205.30, Morningstar at $227, Fast Graph at $198, Yahoo at $244, and my dividend discount model analysis at $2.07. My dividend discount model analysis, I use a 10% dividend growth for the next 3 years. How they just recently increased it by 15, and analysts expect about 9, 10, 11% growth for the next 3 to 5 years. So that's why I use a 10%. And after that, I use a 5% growth, again, because the revenue has been flat and they've been efficient growing their net income and earnings. But you're only going to go that far with revenue, so you need to start increasing revenue. And averaging out the 5, we get a fair price of $216.54. Currently, the company goes for $241.35. That means it's overvalued by 10.3%. So with that, my recommendation is a hold. So I have a hold recommendation for APD. Now, fundamentally, the company is amazing. Very low debt to equity. The current ratio is high, which is great. It has an A credit rating for investment grade, outstanding. And they increased the dividends by 15.5%, as you saw in the presentation. So overall, this is a great company. I personally don't own it, but at current prices, I'm wary of it because of the high valuation. If it was in a P of 20 or even 19 or 18, I would definitely consider it as a buy because of the high quality company it is. But with a PE of 28 versus the 5-year average of 25, I'm very it's very too high for me. So what I'm going to be doing, and I've had this company in my watch list, it's always been overvalued based on earnings, but the price continues going up, and that's okay because I find opportunities elsewhere while I'm still waiting for this one. So I'm being patient until the price point is attractive for me. So APD is definitely a company that you should have on your watch list and do some research and come up with a price point yourself so that when it hits it, buy it, because this is definitely a company that's going to be long term. The balance sheet is amazing. Earnings growth, dividend growth has been amazing. So this is definitely a company that's worthy of being part of your portfolio. So thank you for watching. Make sure to subscribe and like this video. For tomorrow, I'm going to post another one of a Dividend Aristocrat. So make sure to subscribe so you'll be notified. And thank you for watching, and I'll see you in the next one.